All right. Good morning, everybody. So we get to start the week all over again. Last week, we had the morning briefing where I warned you job numbers are always worth keeping an eye on. And that includes revisions, right? We have the projection of what they anticipate the numbers to be, and then we have what numbers we actually get. And at the same time, they can come in and rewrite previous numbers. And that's really what whacked us on Friday. So there's all this talk of replacing the person in there with somebody else, but the process won't change. It's still going to be the same old, same old. And this has been a problem for administrations on end forever. There was an article that talked about how these numbers have changed over the years. It's worth hitting your favorite AI and asking it, when the numbers changed, the formula that they use, the data behind it. If you want to nerd out on it a little bit, kind of get a better understanding of how the data is derived and how it's changed over the years with, more of the government getting into computers and moving data more swiftly. It's not really going to bother us today. The main thing today is just going to be surprise headlines, if we get any, and the ISM numbers tomorrow. So Hong Kong's trying to come back. Japan as well. They were both red earlier. They're just trying to work their way back into the green. Europe on the run. Keep your eye on that at Europe's close. Because if they're helping us with this push and then they go into the close, it oftentimes removes whatever push we were getting from them, and then we just kind of stall out. We're not really getting an outsized move in small caps this morning compared to what we've seen over the last few weeks with them dominating in the pre-market. I mean, they're up, they're keeping up, and they're doing better than the Dow, but this could be a small tell on the idea that maybe we're done with the small cap meme stock, low float, left for dead trash that's been kind of bobbing to the surface lately. It certainly hasn't been one of those hedge fund factor rotation plays. It's been a little bit different. The Dow is dragging its feet, but it's up there. It's trying to keep up. So quiet morning today, bigger stuff tomorrow. If you're going to be trading in the overnight tonight, keep your eye on that 10-year bond auction with the JGB and the 10-year Japan. We're getting closer to the Jackson Hole event, which, by itself isn't normally that big of a deal, but well, Powell's been under a lot of pressure lately, and he does have a history when it comes to Jackson Hole of using it for his own little soapbox. What I've got marked out here before I added any of the indicators is something we were talking about on Friday. So we've got the RTH, and it's got its own drawing. Just all of that. It's kind of compressed really after the overnight run. High to low, 786, half back, all the regular pieces of the puzzle. And then we have everything from yesterday, from the highest point to the lowest point. And as is often the case, the RTH high on Friday lined up with the halfback for all of this. That's why you don't see a 1 here. You just see the halfback. So this level of resistance, 63.11 cog line, which is Friday's RTH high, is also Friday's halfback if you measure the entire range. That's 3 levels right there. Yesterday's RTH mid, RTH high, all of yesterday's mid, and it's the cog line. So if we can get above it, great, but it's going to be hard to get above it when it's a significant level of resistance, and it's 3 levels of resistance. $62.28 put wall is below Friday's low, so we would need an inside day breakout to challenge that put wall. And they've had time now to really consider what they're going to do with those puts when we get down there. But we have the 10-week down there as well. 6,200 is the 10-week. So if we overshoot the put wall, we got 62.11 cog line, 6,200 round number, and it's the 10-week. It's very likely going to provide a first touch, and we could flip back the other way at least for a little bit. We've got 0 gamma and the volatility trigger kind of wrapped up nice and tight. We're below the 10 and the 20 on the daily. So of course we're also below the 3-day. So when we do bring up the daily, we don't have a 10-20 cross yet, but we've got price under the 10 and the 20, and it's under the 20 far enough that it could drag the 10 down there pretty quick, all things considered. We have not yet set a high up here. We don't know if it's going to be a lower high or a higher high. We don't know. And since today's not done yet, we don't even know if this is going to be a low yet, because this day could still turn red. It could fall lower, and then we wouldn't have a low at all. We would just still be waiting to set that low before we could run up and set a high. So for all the talk of, are we going back up? Are we going to continue to go lower? Should I get long? Should I get short? We don't have any information yet. You can play the shorter term trades, which is focusing on Friday's halfback. And if we can get through that half, you can focus on the half of this entire drop. But for the bigger picture, we don't have enough information. And if we break this low, then 200 is on the table. That's 6,200. And then the 50-period moving average, which is 61.92 cog line. And if that don't hold, then we're headed down to the 200-day moving average, which is around 6,000. Just the way it goes, right? Level by level by level. We don't have any reason to believe it's going to get that bad. The moves that we saw on Friday was more from a shock of the numbers than the numbers themselves. And there's a lot of good numbers that was still tucked in there, right? Markets don't like surprises, so they didn't like that revision coming in so heavy as it did. So we still need to play it out, and you can place your bets and pick your sides, but with this data alone, we don't have enough information. You're going to want to bring in additional charts, sector review, volatility, CTAs, treasury. We made it to one side already. Generally speaking, if we get to one side early enough, we can go to the other side by the end of the day. The negative note on that is that we gapped down and then we opened, and that's where the lines came from. If we had not gapped down and we had just opened, these lines would have been higher by a few points. Let's call it eight points. So we still would have been there. We still would have overshot it, but we wouldn't be so close to the yellow line as we had gotten. Either way, the phrase about getting to one side early enough to get to the other side by the end of the day, it doesn't account for getting on top of one of those lines or getting past it. If we had got to the downside, for an example, and we bounced off of it, we'd look to get to the other side by the end of the day. But if we get to the other side and we get underneath it and we're holding there underneath that line, it's a lot harder to see how we're going to get up back to the other side by the end of the day. So we have to break this 62.85 to get the other side. On top of that, we still would need to break yesterday's RTH low because this would be an inside day breakout just to get here. It doesn't owe us that. So one of the things that's worth talking about today is what happens if we get above the yellow line or we get beyond the yellow line. Well, these are average daily range levels. So we can take that and start doing some math with it. Right now, we've got, call it a 58 point higher and lower. That's 29 split. So you could take $29 or 29 points and add it to the top of this. And then you could take 58 and add it to the top of this. That'd give you another 2 levels. And then, of course, the measured move, the quadrants, all of that. But it's more likely that pivot point SNR levels will be more helpful. So we're under the weekly floor pivot. That's bearish on the week. We got to get above that 63.24 level. We're inside the channel at this point, so that'll help. We need to keep it. Today's floor pivot is lower than yesterday's. That's bearish. Price opened underneath it. That's bearish. We're back above the daily pivot and another line that we need to keep. So because of the expansion on Friday, the R1 is 63.46. It's kind of a long ways off. If we do get through the yellow line that we were talking about, getting to R1 makes perfect sense. It's what price does, right? When we get above a floor pivot as we go to the R level. So we do have the weekly pivot to contend with, but if we can get through that, then we've got R1. There's no reason to think we're going to get crazy bullish and get to something like an R2, but if we can get above R1 and keep it, then yeah, it's possible that we can keep going. We do have the other side of the channel to deal with, 63.54. I really don't see us getting beyond R1 today. If we get there really early for some reason, then we could mean revert back down to the floor pivot by the end of the day. If we don't get headlines, it's very likely that we're going to just maintain our position here and not make new lows, but really not retrace much of Friday's move. All right, we can see with the two distributions, they put a lot of work in on Friday. And now we've got this shallow area that really shouldn't give us too much problem. We can move through shallow areas really quick. We didn't leave much footprint behind, nothing to really hang us up. This morning, though, and this isn't really the chart for it, but we can see that most of the volume came in up here where we're at above 6,300, not last night where we opened up. If we get out of this big distribution from Friday on the downside, there's really nothing down here to help us out until 6150, like we talked about in these streams, right? I warned you guys a while back that we would, underneath this 250, we would start moving in 100 lot increments from 250 to 150, and then to 6050, and then 5950. That's what we did once we broke 6350. We went right down to 6250. So that's the next stopping point if 6250 breaks. Day 30-minute volume profile with TPO. We've put in a lot of work down here as it shows on the 30-minute. So this is now the width of our profile. It's not going to go away for weeks. We're going to have this wide of a range. We were potentially going to shrink that up, right? Last week we were looking at losing a good 100 points off of this range, but then we had this move. So that's off the table. Now we got to consider where the new point of control is going to be. And it's not likely to come down to us in one shot. It's very likely it is going to have to walk down. But we'll see how it goes because we're going to lose these candles here, which is where this volume comes from. So it wouldn't by default drop down there because that won't be there. So where is it headed? It'll end up coming down into this level if we stay down here and build it out some more. At this point, we've built, you can call it a bear flag, a bear pennant, whatever suits you. They both have the same outcome unless it's a failed flag or a failed pennant. And at this point, we don't have enough information yet, but it is starting to set up like a failed flag or a failed pennant. If you think about what a flag is supposed to do, it continues to the downside. We call it a failed flag or a failed pennant because it gets down there and it starts to build that range and stays there too long, ends up running back up, which forms a really nice cup, maybe a handle. We don't have any of that yet. So we need to get out of the box that we're building down here. $62.83 VPOC is finally hit. It's taken off the board. The VPOC from Thursday is still in play, and the value area low that I marked off from Thursday is still in play. Don't normally mark those, but the textbooks would tell you to mark it all the time, right? I just generally mark the ones that haven't been hit yet. So this point of control, it hasn't been hit. That's why I marked it. We wouldn't mark one for Friday because we opened and then we ran right through that. So I wouldn't mark it, but the textbooks would tell you mark it anyways. I've got enough pivots. I don't need more. A little discrepancy between the TPO's point of control and the volume profile's point of control, and the value area is way off between these two at the moment. Give them a little time. Keep an eye on them as we get closer to the open, see if they start to get in sync. Right now, 6,300 is where the greatest amount of volume on the day has been. If Europe gave us something, sure doesn't look like they gave us much. Still, keep your eye on Europe's close today. It could be a change of market structure at that point. So we ended the week outside of the box. And on Friday, we took a look at what this current week had to offer as a bit of a projection. But it wasn't set in stone. Now that we're on the new week, now it's set. It won't move. And we can see that the current week has a lot more volatility priced into it than last week did. Now, at first blush, that just tells us that the market's concerned. They started pricing in a lot of volatility for this week. Within the trades that they took on Friday, they showed the market that they were concerned about this week's price action. And not because of some thing on the economic scale, right? Not like a FOMC, CPI, non-farm payroll. Those are known unknowns. This is an unknown unknown. The difference being when we know it's CPI or non-farm payrolls or FOMC, the market's price in a sideways week, a lack of movement, because they know that for at least part of the week, we're not going to do anything except sit on our hands and wait for data. So we end up with a more narrow week on those big event kind of weeks. Price may not end up being range bound like we would think it is, but the projection ends up being really narrow. And we've seen that time and again, right? FOMC weeks, it's a narrow box, it's a small range, or OPEX, narrow range box. This isn't that. This is a much wider range from an unknown unknown. A known unknown would be, hey, we got an event, but we don't know what the event is going to give us. So we know the event is coming. We just don't know what the numbers are going to be. An unknown unknown is there's something coming and we don't know what it is, and we don't know how it's going to affect us. Now, we've seen this in the past where it happens. We get these really wide boxes, and then whatever the market was scared of never materializes. Nothing comes out of it. We don't see big moves, and it's just nothing. It's, chalk it up to another day lived. Then we've seen these big weeks be the canary in the coal mine for, things to get a lot worse from here. So just like looking to see if this is our low yet, we don't know yet if this week is foreshadowing something that's going to get worse, or if it just turns out to be nothing and we run back out again. But you can see what the range was last week and what the range is this week. We've got a lot more volatility in the market this week than we did last week. Volatility is just a nerd word for movement. So implied volatility is promised movement. Some of the biggest bull days we've ever had in the history of the market came during bear market conditions. Keep that in mind. Just because the market is a little concerned and we're down doesn't mean that we have to go down. We're still 1.5% above the 10-week. We've been talking about getting back to the 10-week since April, and we've continued to outrun the 10 all the way since then. And we're still not back yet. We're just a lot closer. So we're not overbought. We're not oversold. We haven't moved too far, too fast. It doesn't owe us any sort of mean reversion or movement back in the other direction. We're still above the 10, so we're still good at this point. Looking at the daily, however, we are underneath the 10-day. First time since, I guess it depends on when you want to count it. It's been a while. We dipped down there in mid-July for a day and then came right back out of it again. But we're down there and we're holding it at this point. Now we are picking up off of the low that we set. See what we're going to do with it from there. And we're still going to need to outpace that 10, right? Every day the 10 is moving. And if we want to stay above it, then we've got to move farther than it's going to move. At this point, the goal is to get back above the 10 and maintain about a 1% distance above it, but one step at a time. This also shows that we're not overbought, we're not overextended, we're not oversold. This move last week is not enough to expect any sort of mean reversion or least squared methods or dot plot statistics or anything else that suggests that we're going to push back just because of how far we fell, because we didn't fall far enough for that sort of behavior. A rising tide lifts all boats, but a falling tide drops all boats, except utilities, apparently. So what we're looking at here is 9 different sectors, broken down into grids of 3. Top 3 are risk on, bottom 3 are risk off, and the 3 in the middle are midline. In poor economic conditions, the bottom three generally do better. And in quote, good economic conditions, or when people are exuberant and willing to take risk, then the top three tend to do good. But times are changing, and utilities are connected more and more to AI data centers and technology. And so it doesn't really fit in that old school basket down there anymore. We're going to have to come up with some other grid soon. But it's the only thing that's up over the last 5 days compared to everything else. And we've got some that are down close to 5%, 3%. But staples is down the least. Utilities is up the most. And sure, I mean, healthcare is getting beat down, but healthcare had a really good run on AI and tech. And it's not a surprise that it got whacked when tech got whacked. Times are changing. So when we're looking for a flight to safety or a capital rotation through the sectors, the expectation is that these defensive names will fall less and or actually be green while everything else is red. And at this point, we're not seeing that flight to safety turning these green. Sure, utilities is, but we got to ignore that one. It'll be something to keep your eye on through the day today. If we will always find some stock that are going up, right? That's just doesn't matter how bad it is out there. There's always something going up. But what the something is will matter. Is it healthcare and utilities and staples, or is it tech and finance and consumer discretionary? Looking at what's down this morning, the VIX was up more than 20% in a 5-day period. Well, actually, it was up 26%. Now that it's down 5.5, it's still up over 20% in a 5-day period. So the VIX is fading off of that pop from Friday. The Mag 7 down volume is down. I know that gets a little confusing, but there it is. It was up about 10% in the last 5 days. Looking at what's up this morning, China Mag 7 up, volume is up. China again. China again. Gold miners, Bitcoin, Mag 7 again, Bitcoin again. Emerging markets, so that's China again. Robots, tech, chips, need more of that. So we got some supporting structure to stop us from falling. I don't know if it's going to be enough to get us to rally, but if we got the Mag 7 and chips and Bitcoin and China, we've got enough to get a rally. We've even got some finance in there. It's close enough to call it. That's the three that we need for a risk on rally day. So we've got it. We just need to keep it. "28 names in the S&P are up at least 0.5%. It's a good start. You can see we got a lot of finance in there. And a lot of the Mag 7 is in there. "43% of the NASDAQ 100 is up at least 0.5%. Lots of chips, Mag 7, cruise lines, casinos, resort hotels, frivolous spending. All right, when you set the heat map this way, use the NASDAQ 100, you can set it by market cap, and then the size of these boxes shows you where the Mag 7 is, the biggest boxes on the grid. And you can see that almost all of them are in the green. Google's almost there. Once it reaches a 0.5%, it'll turn green. Netflix is kind of dragging its feet a little bit, but otherwise they're all up. They're all in the green, and these are the ones that we have to have. They can be flat and it'd be okay, but they can't be down, right? Or we can't rally today. So the fact that they're rallying says that we can rally as long as they keep going or they just stall out and don't fall back down again. But if you look at the broader market, a lot of this stuff, it's not down. It's just not up. Costco and a lot of communications names, services, communications. So not up is better than being down. And that also says that we could have a rally day. We just got to get it, right? So we want to see that VIX drop back down below $20. It's kind of a old school line in the sand. As long as it's maintaining above $20, then it starts to put us into that market correction, quote, deeper pullback sort of behavior. We don't want to be there. Now, crude's got this real big liquidity bar from June 23rd and the year-to-date anchored VWAP down here. So we want to keep this low, 72.50, the line in the sand on crude. It's getting whacked pretty good this morning, but it's still above 75. Keep our eye on that. If you're in that CL short put spread, then want to make sure that we don't expand below this low. Pot stocks are down. So top names on the list, China, and then uranium, gold, precious metals, Bitcoin, China again, then the Mag 7, more precious metals, tech, chips. I'd like to see cloud up more. When we say tech, it's just kind of generic, right? It's a broad, generic description. Cloud computing's more specific, kind of narrows the focus a bit, and it's up a little. It doesn't really get much pre-market activity. You can see just a little dot there. It's a little algo print at 22. We need more than that, right? So it says that it's up a little. It's just a print, just a little dot. Let's get more out of that. See what communications is doing once we get closer to the open. Otherwise, we're looking pretty good as a starting point. These need to stay green, or, well, yeah, they just need to stay green. They don't, they start turning red or giving it all back, then we're going the other way. And then once we get into the open, keep your eye on the options flow. So we got a really simple day today, all things considered. Get through the Friday's intraday high to get anything else done to the upside. And that's 3 levels of resistance. Otherwise, we've got our own Globex low and our Globex mid to deal with, 62.80. And after some of the questions I saw last week, who people were confused with this word Globex, global extended hours, it basically is just anything that's not the regular trading session. So if you're trading stocks, you could say it's, after hours and pre-market. If you're trading futures, then it's just anything that wasn't regular trading hours, Globex. Right? Just keep it as simple as that. So we got to get out of this or we can't get anything else done. And the base case today is that we're going to reclaim a lot of this drop from Thursday and Friday, or we're going to sit down here and chop. I don't think it's going to get worse from here and that we go lower unless we get some headlines that we can't anticipate, right? If we do break this Globex low, then we'll challenge the low of yesterday. And then there's a 111 and a 1236 that's down here. And that'll be the reversal signals for the run back up. If we're not expecting to go lower, then we should, at the worst, peak outside of yesterday's low, come back in, keep it. Should be a simple day, all things considered. That's what I got for you guys. Be careful, be safe. I'll see y'all tomorrow.